There's a specific moment in every billionaire's life that determines everything that comes after. And it's not when they made their first million. It's not when they sold their company. It's not even when they came up with their big idea. It's what they did with their first $20,000. Because here's what nobody tells you. Every single self-made billionaire, Bezos, Cuban, Oprah, Musk, treated their first $20,000 completely differently than you've been taught to treat money. They weren't buying index funds. They weren't maxing out retirement accounts. They weren't even thinking about financial security. What they were doing with this money is so counterintuitive that it contradicts everything your parents, your financial advisor, and every personal finance guru has ever told you. But when I analyzed the data on over 200 self-made billionaires, the pattern was unmistakable. And it's the difference between building $100,000 over a decade and building $10 million. My name is Grayson Cole, and I love to talk about money and do research on billionaires. So subscribe if you want to learn how billionaires spend their first $20,000. Here's what nobody tells you about billionaires when they were starting out. And I'm not talking about trust fund kids or people who inherited wealth. I'm talking about the Jeff Bezos types, the Sarah Blakely types, people who built empires from middle class beginnings. When they got their first $20,000 saved, they didn't treat it like safety money. They treated it like ammunition. Think about that word for a second. Ammunition. Because that's exactly what it is in their minds. You don't stockpile ammunition just to feel safe. You stockpile it because you're planning to engage in battle. And in the world of wealth building, that battle is capturing opportunities that 99% of people completely miss. Here's where conventional financial advice completely fails you. Every guru tells you the same thing. Build your emergency fund, get 3 to 6 months of expenses saved, sleep better at night. And look, I get it. There's wisdom in having security. But here's the problem with that advice. It's designed to keep you safe, not make you wealthy. Billionaires understand something fundamental about money that most financial advisors either don't know or won't tell you because it goes against their liability concerns. The highest returns in your entire investing lifetime happen in the first $20,000. Not in your first million. Not when you're sophisticated enough to invest in private equity. Right here, right now, in that first $20,000. Let me show you what I mean with actual numbers, because this is going to blow your mind. The average investor, someone following traditional advice, puts their first $20,000 into a high-yield savings account, earning maybe 4.5% right now. Or if they're being aggressive, a diversified index fund averaging 8 to 10% annually. And yes, that compounds nicely over 30 years. You could turn that $20,000 into about $200,000 if you never touch it and the market cooperates. That's the conventional path. And it's fine. It's safe. It's what your parents probably did. But here's what billionaires do differently. And this is based on research from the Journal of Financial Economics, tracking the early investment patterns of ultra-high net worth individuals before they became ultra-high net worth. They used that first $20,000 as what's called asymmetric opportunity capital. That's fancy Wall Street speak for money you can afford to deploy aggressively because you're young enough or hungry enough to recover if things go sideways. And here's the key insight. They're not trying to preserve it. They're trying to 10 times it. Warren Buffett's first major investment wasn't diversified. He bought a failing textile company called Berkshire Hathaway and turned it into a holding company. That was a concentrated bet. Mark Cuban sold his first company for $6 million and immediately put a huge chunk into AudioNet, which became Broadcast.com. Another concentrated bet. Sarah Blakely cut the feet off her pantyhose, invested $5,000 of her savings to patent the idea, and turned it into Spanx, now worth over $1 billion. Concentrated bet. The pattern is unmistakable. When they had limited capital, that first $20,000 or $50,000, they didn't diversify it into oblivion. They concentrated into their highest conviction opportunity. Now, before you think I'm telling you to bet everything on cryptocurrency or your cousin's startup, let me explain the psychology that makes this approach work and why it only works at the specific wealth threshold. When you have $20,000, you're at what behavioral economists call optimal loss tolerance. You have enough money to make meaningful investments, but not so much that losing it would destroy your life. You can recover, you can rebuild. You're in the zone where aggressive moves make mathematical sense. But here's what changes as you get wealthier, and this is crucial. The more money you have, the more conservative you need to become. It's counterintuitive, right? You'd think rich people take bigger risks, but the opposite is true. Once you have $5 million, you don't need to 10 times it to have a great life. You need to preserve it and grow it steadily. The risk-reward calculation completely flips. This is why you see billionaires investing in boring things like treasury bonds and blue chip stocks once they've made it. They're playing defense. But at $20,000, you need to play offense. Pure, aggressive offense. And here's the part that makes this so powerful. You have the one asset that billionaires would pay anything to get back. Time. If you're in your 20s or 30s or even 40s with $20,000, you have decades to compound not just money, but skills, networks, and opportunities. This is your only window where asymmetric risk actually works in your favor. So what do billionaires actually do with that first $20,000? I've identified 3 distinct strategies, and here's what's fascinating. They almost never pick just one. They split the money across these 3 categories in different proportions based on their skills and market conditions. Path 1. Self-investment at 10 times returns. This is the path that 78% of self-made millionaires took, according to Thomas Stanley's research. They invested their first meaningful capital into themselves, specifically into skills or certifications that had direct ROI. I'm not talking about a random online course. I'm talking about strategic capability building, a real estate license, a coding boot camp that leads to 6-figure jobs, a financial planning certification, a specialized sales training program. Here's why this works. When you invest $5,000 into the right training and it increases your income by $30,000 per year, that's a 600% first-year return. And unlike stock market gains, this return repeats every single year for the rest of your career. Let me give you a real example. I know a woman who spent $8,000 of her first $20,000 on a specialized certification in cloud architecture. Within 18 months, she went from making $65,000 as a general IT person to $140,000 as a cloud solutions architect. That certification has now generated over $800,000 in additional lifetime earnings. Show me an index fund that can do that. Path 2. Controlled entrepreneurial bets. This is where it gets really interesting. Billionaires don't start with huge, crazy business ideas when they have limited capital. They start with what I call cash flow positive micro businesses. These are businesses that can be started for under $10,000, generate positive cash flow within 90 days, and have the potential to scale. Think service businesses, digital products, niche e-commerce, specialized consulting. Jeff Bezos started Amazon with $10,000 from his parents and $84,000 from other investors. But the key is, he started it. He didn't wait until he had millions. He took his window of optimal risk tolerance and deployed capital strategically. Here's the success pattern. Take $8,000 to $12,000 of that first $20,000 and start a lean business in an area where you have expertise or access. Not a moonshot, not the next Facebook. A simple business that solves a specific problem for a specific group of people who will pay for that solution. The goal isn't to build $1 billion company right away. The goal is to turn $10,000 into $50,000 in 12 to 18 months while learning the mechanics of business, customer acquisition, pricing, operations, scaling. If it works, you now have $50,000 in proven business skills. If it fails, you're back to zero, but with invaluable knowledge about what doesn't work. Either way, you're ahead of where you'd be with that money sitting in a savings account. Path 3. Asymmetric opportunity investments. This is the path most people completely misunderstand. When I say asymmetric, I mean investments where your downside is capped, but your upside is potentially unlimited. Billionaires in their early wealth-building phase look for these opportunities constantly, and they're not in the stock market. They're in early-stage equity in companies where they can add value, not just passive investing. Real estate deals where they're bringing something other than money to the table. Intellectual property opportunities with massive leverage potential. Strategic partnerships where $20,000 opens doors to much larger opportunities. Here's a real example. A guy I know used $15,000 to secure exclusive distribution rights for a specialized industrial product in his region. That $15,000 bought him the legal right to be the only seller of this product in 3 states. He didn't have to manufacture anything or hold inventory. He just connected buyers with the manufacturer and took a percentage. That turned into a $400,000 per year business. The investment was $15,000. The upside was unlimited. The downside was losing $15,000. That's asymmetric. Now here's where most people completely blow it. And I see this constantly. They get their first $20,000 saved. They feel this incredible sense of accomplishment, which they should. And then they make the single biggest wealth-destroying decision possible. They immediately upgrade their lifestyle. They buy a nicer car because they've earned it. They move to a more expensive apartment because they can finally afford it. They take an expensive vacation because they've been so disciplined. And just like that, they're back to zero. Or worse, they're back to zero with higher monthly expenses. Here's what billionaires understand that breaks this pattern. That first $20,000 isn't the finish line. It's the starting line. This is the capital that determines your entire financial trajectory. Spend it, and you're resetting the clock. Deploy it strategically, and you're compressing decades of wealth building into years. Let me show you the math on this because it's stunning. Person A saves $20,000, gets excited, buys a $25,000 car with their savings as a down payment and a loan. They now have a $400 monthly payment for 5 years. After 5 years, they've paid $24,000 for the car. It's worth $12,000. And they have lost $12,000 in value plus all the opportunity cost of what that money could have earned. Person B takes that same $20,000 and puts $12,000 into a side business that generates $2,000 per month in profit. Within a year, they've made $24,000. They take that $24,000 plus their original $8,000 reserve and now have $32,000. They reinvest $20,000 into scaling the business, keep $12,000 as emergency funds. By year 3, the business is generating $6,000 per month. They're now making $72,000 per year from something they started with $12,000. Same starting point. Completely different universe of outcomes. Here's something that's going to change how you see that first $20,000 forever. It's not actually worth $20,000. Not in real terms. When you factor in the time value of money, the opportunity cost, and the compounding effects of early strategic decisions, that first $20,000 is worth somewhere between $200,000 and $2 million in lifetime wealth impact. I'm not exaggerating. Let me break down why. If you're 30 years old and you invest that $20,000 in the stock market at 10% returns, by age 65, you'll have about $630,000. That's the traditional path. That's not bad. But if you take that same $20,000 and invest it into a skill that increases your income by $25,000 per year, and you invest that extra income at the same 10% rate, by age 65, you'll have approximately $6.8 million. Same starting capital, different deployment strategy, 10 times the outcome. This is what billionaires intuitively understand about early capital. It's not about the dollar amount, it's about the strategic positioning it enables. When Mark Cuban was starting out, he didn't just save money. He used every dollar strategically to position himself for the next opportunity. He lived with 6 guys in a 3-bedroom apartment to keep expenses low. He taught himself to code because hiring developers was too expensive. He negotiated equity instead of salary whenever possible. Each of these decisions compounded. The money he saved on rent went into his business. The coding skills made him more valuable. The equity positions created asymmetric upside. By the time he sold Broadcast.com for $5.7 billion, he wasn't just lucky. He was the mathematical result of thousands of strategic micro decisions made when he had very little capital. Now let me tell you about something that most people don't realize about how wealth actually works in America. And this might make you uncomfortable, but it's absolutely critical to understand if you want to build real wealth. That first $20,000 isn't just money, it's access. In the world of high net worth individuals, there are opportunities that literally don't exist unless you can write a check. Private placements, angel investments, real estate syndications, private lending deals, strategic partnerships. These opportunities routinely generate 20%, 30%, sometimes 50% annual returns. They're not advertised. They're not available on Robinhood. They're shared in private networks among people who have capital to deploy. And here's the kicker. The minimum check size to access these deals is usually between $10,000 and $50,000. So that first $20,000 is your admission ticket to a completely different financial universe. Without it, you're stuck with retail investment options, mutual funds, ETFs, savings accounts that are fine, but they're competing against millions of other retail investors for the same mediocre returns. With $20,000, you can write a $15,000 check into a private real estate deal that returns 25% annually. You can angel invest in a startup where you have domain expertise. You can partner with someone on a business acquisition. I know someone who used $20,000 to invest in a friend's equipment financing business. His friend needed capital to buy equipment that he would then lease to contractors. My friend's $20,000 got him 20% of the company. That company now generates $180,000 in annual profit, so his share is $36,000 per year. He turned $20,000 into a perpetual $36,000 annual income stream. That's not compound interest. That's compound access. Here's something else billionaires do with their first meaningful capital that almost nobody talks about. They build what I call a skill stack that makes them asymmetrically valuable. You're not going to compete with billionaires on capital. You're 30 or 40 years behind them, but you can compete with them on skills acquisition, especially in the early stages. And here's what's beautiful about this. The skills you build with that first $20,000 become the foundation for every dollar you make afterward. Let me give you the formula that self-made billionaires follow. They take 40% of their early capital and invest it in developing 3 specific types of skills. 1. A primary income skill, something that directly generates money. Sales, coding, financial analysis, specialized consulting, a licensed trade. This is your base layer. This is what pays your bills and generates capital for investments. 2. A leverage skill, something that multiplies the impact of your primary skill. Marketing, public speaking, writing, networking, leadership. These skills take your primary income skill from generating $75,000 per year to $200,000 per year. 3. A wealth building skill, understanding financial statements, deal structures, valuation, negotiation, strategic thinking. These skills help you deploy capital effectively once you have it. Most people never develop all 3. They get good at one thing, max out their income potential, and wonder why they're not wealthy. Billionaires systematically build all 3 skill sets, and they use their first $20,000 to accelerate this process. I'll give you a real-world example. There's a woman who used $7,000 of her savings to get a real estate license, primary income skill, then spent $3,000 on a marketing course to learn how to generate leads online, leverage skill, then spent another $2,000 on a financial modeling course to understand real estate valuations, wealth building skill. Within 2 years, she was making $180,000 per year in real estate commissions. But here's where it gets interesting. Because she understood valuations, she started identifying off-market deals for herself. She partnered with investors who had capital but not expertise. She put up her knowledge, they put up the money, they split the profits. 10 years later, she owns 23 rental properties worth $8.6 million with about $3.2 million in equity. And it all started with $12,000 invested strategically into skills that compounded. Here's something that's going to sound controversial, but it's absolutely true. Billionaires don't actually try to hold on to their first $20,000. They try to spend it as fast as possible. Think about that. While you're being told to save and preserve and protect, they're thinking about velocity. How fast can I turn this into something bigger? This is called capital velocity, and it's one of the most misunderstood concepts in wealth building. High net worth individuals understand that money sitting still is money dying. Inflation is eating it. Opportunity cost is destroying it. So they're constantly asking, how can I deploy this capital, generate a return, get it back, and deploy it again? Let me show you how this works in practice. Traditional investor puts $20,000 in an index fund. It sits there for 10 years, grows to about $43,000. One cycle, one return event. High velocity investor puts $20,000 into a 6-month house flip, makes $8,000 profit, now has $28,000, immediately deploys $25,000 into another flip, makes $10,000, now has $38,000 in 12 months. That's 2 cycles in the same time period. But here's where it gets really powerful. The high velocity investor isn't just making more money. They're learning faster. Each cycle teaches them something new about deal structure, risk management, market timing. By the time the traditional investor has been through one market cycle, the high-velocity investor has been through 6 or 8 cycles. They've made mistakes and recovered. They've identified what works and what doesn't. They've built a network of partners and collaborators. This is why billionaires often seem to have an unfair advantage. It's not that they're smarter. They've just compressed more learning cycles into the same time period by keeping their capital moving. Now, I know what you're thinking. This all sounds great, but what about risk? What about security? What if it all goes wrong? And here's where we need to have a really honest conversation about risk, because the way most people think about risk is completely backwards. You think keeping your $20,000 in a savings account is low risk. But what's the risk of being 50 years old, still working a job you hate, with no path to financial independence? That's not low risk. That's guaranteed loss. You think investing in yourself or starting a business is high risk. But what's the risk of having the same skills at 40 that you had at 25? Of never developing the capabilities to command high income or build equity? The real risk isn't losing your first $20,000. The real risk is keeping it so safe that it never transforms into anything meaningful. Billionaires understand this intuitively. When Warren Buffett was asked about his investment philosophy, he said something profound. Risk comes from not knowing what you're doing. The key word there is knowing. If you invest your $20,000 into a skill you're learning, that's not risky. You're gaining knowledge even if the financial return takes time. If you start a business in an area where you have expertise, that's not gambling. You're leveraging what you know. The only truly risky move is doing nothing, letting that $20,000 sit and slowly lose purchasing power while you gain no skills, no experience, no network, no positioning. Here's what I tell the people. Protect your downside by investing in yourself and opportunities where failure still teaches you something valuable. But don't protect yourself into mediocrity. So here's where we are. You've now seen how billionaires treat their first $20,000 completely differently than conventional wisdom suggests. You understand the 3 paths: the velocity principle, the access advantage, the skill stack. The question is, what are you going to do with this information? Because here's the truth, and I need you to really hear this. You're at a decision point right now that will determine your financial trajectory for the next 20 years. If you have $20,000 saved, or you're close to it, you have a choice. You can follow the safe, conventional path that keeps you comfortable but never wealthy. Or you can follow the billionaire blueprint that feels uncomfortable but creates asymmetric opportunity. Neither path is wrong, but they lead to completely different destinations. The conventional path leads to a comfortable retirement at 65 or 67, a nice house in the suburbs, a few vacations per year, a stable, predictable life. And there's nothing wrong with that if that's genuinely what you want. The billionaire path leads to potential financial independence in your 40s or even 30s, the ability to take big swings on opportunities you believe in, building something that could employ dozens or hundreds of people, creating generational wealth that changes your family tree. But it requires something the conventional path doesn't: strategic risk-taking in your window of optimal opportunity. Here's my challenge to you. Look at your first $20,000 not as an emergency fund or a safety net, but as the most important capital allocation decision of your life. Ask yourself, if I deploy this money strategically into skills, into a business, into asymmetric opportunities, what's the best possible outcome? Then ask, can I handle the worst possible outcome? If the answer to that second question is yes, then you know what to do. The billionaires who changed the world didn't play it safe with their first $20,000. They recognized it for what it actually was: rocket fuel for a completely different trajectory. That same opportunity is sitting in your bank account right now. The question is whether you'll have the courage to ignite it. If this changed how you see your financial future, hit that like button and subscribe, because I'm breaking down the exact playbooks that billionaires use at every wealth level. And trust me, the strategies for the next $100,000 are even more counterintuitive than what we just covered. Your future self is watching this decision. Make them proud.